All right, so I'm running crazy late with this morning's video. So, hey, there's a lot of numbers and the handwriting got messy. So, excuse me, please do not troll me. Do not tell me how terrible my writing is and that my math is off. It could be off. Numbers are big, they're weird. So, please go easy. All right. And if there's errors, just correct them. And before I even get started with any of that, I want to put out my disclaimer, which is that this channel is opinion, not investment advice. Anything you hear, see, listen on this channel, treat it as information, engagement, entertainment, if you wish. I know there are many people that think that the stuff that I put out is sort of amusing and hilarious, and that's fine. But it's not investment advice. Investment advice takes into account your particular financial situation and considers that in its actions. On top of that, anything you choose to do with this, win or lose, gain or loss, buy, sell, whatever you choose to do, it's on you. It's your money. It's your responsibility. Having said all of that, today's video is on Fannie Mae, ticker symbol FNMA, and Freddie Mac FMCC. All right. So these are two stocks that have been trading in essentially like purgatory, limbo land for about 14 plus years. You have to go back to the global financial crisis of 2008 to get all of the backstory. You can check out one of my videos from about a month and a half ago. We'll try and put up a link that'll show up in one of the corners to the video if I can get Dean to do that for me. And that'll give you some amount of the backstory with respect to Fannie Mae. But this video really applies to both of these stocks because in many ways, they are like Coca-Cola and Pepsi. They're just, they both do similar things. Fannie Mae is bigger, Freddie Mac is smaller. And skipping the backstory, let's go to why I'm making this video today. And the reason to make the video today is, scary, right? Debt ceiling. I don't know, the markets really don't seem to care that much, right? The stock market's been up since this issue really, became prominent. Crypto markets are up, bond markets are up. So I'm unclear that really all the most catastrophic things that people are talking about really are truly relevant. It seems to be that legacy media, I'm talking about like CNBC and Wall Street Journal, this is a way to get people to either watch or read newspapers or subscribe, whatever. But very quickly, what's the debt ceiling? Well, essentially the government's credit card. And the government has this really high credit line. Like, wouldn't you like to have $31.4 trillion? 31.4 trillion, folks. Yeah, trillion. That's the debt ceiling. Yeah. 31.4 trillion. That's like to the moon. And then I think past Mars. For sure. We'd have to take Elon's Starship like far, far away to get to 31.4 trillion. It's a long, long way away. Well, bottom line, I don't do politics. So anything here is, in the realm of financial analysis, economic analysis, market analysis. So with respect to the debt ceiling, and I know it's a political issue, but hey, there's plenty of people that discuss that and argue about that. And I'm sure you can find many channels when discuss this. But bottom line to the debt ceiling is really this, which is that there's various solutions. The solution that is desired at present anyway is, hey, raise the limit, which is like asking your credit card company, to increase your credit limit. Pretty straightforward, except for the fact that the two parties involved that control the bank don't seem to agree as to how to go about this. So there's unpopular solutions. And don't worry, I'm going to get back to Freddie Mac and Fannie Mae. Trust me on this. This is important. Yeah, this background to why I'm bringing this up is important. I'm getting to this. I haven't lost sight of it. All right. Unpopular solutions. Well, spending cuts. Nobody wants that, right? I mean, tax increases. Ooh, no way. Like, nobody wants that either. Now, what is undiscussed is, and here we're getting to the Fannie Mae, Freddie Mac issue, asset sales. People don't think about it, but the US government is a corporation. They got assets. They got a land, I think the gold at the Federal Reserve. I mean, I took a tour once of like the gold in the Federal Reserve. I mean, that belongs to the US government. And then they've got stakes in these two companies, 79.99% US government. And little side note, the reason why it's 79.99% is because if it were 80%, they would have to consolidate the debt onto the government's balance sheet. So the government very cleverly in 2008 only took 79.99%. So it does mean that there is like the stub of these companies that is trading. It trades in the over-the-counter market, and it has been trading for a long time. And in my judgment, given that, yeah, spending cuts, not that popular, tax increases, pretty difficult go. Those are, the two places that, people are going to argue. And, I just read a story this morning talking about how this is going to go at least until May. And there's no sense that anyone really has a common agenda here. So my guess is that we're going to get to the point where the US government is going to start scrounging around, no different than, you and I hit our credit limit. It's because we don't have any cash. I mean, we've tapped the credit card out and nothing left. And so we start looking around. It's like, do I have, some money in this account? Do I have money here? Let me just start to pay the bills. And the US government is going to be scrambling and scrounging around. And I think they're going to come across these two stakes and say, yeah, that's sitting there. And we could use some cash right now, to pay off some of our bills while, things get worked out. So what's those two stakes in Fannie Mae and Freddie Mac? What are they worth? So in this video, I came up with a kind of theoretical value. I have to tell you that, hey, these are very, very rough numbers. And, I don't spend all of my time valuing companies, from sort of ground up, from private level. But plus, I'm a growth investor, and generally speaking, it would be, value investors that would do this kind of valuation, and they might use, different techniques. But I use sales because I'm a growth investor, and so I went back and I looked. All right, so if you go and look at Fannie Mae's sales, they're at about $31.5 billion per year. Yeah, $31.5 billion per year. This is a big, big company. I mean, its footprint is huge. Their market shares, the combined market share of these companies and what they do, which is packaging mortgage bonds, and selling it to investors. I mean, it's like 65%. So, I mean, they're dominant, absolutely dominant in their fields together. Freddie Mac is 22 billion. And many people will challenge this way of looking at it, but hey, this is just a theoretical exercise. Now, it's just, a theoretical exercise. You can use book value, which might be a better and fairer representation of what these companies are worth. But just bear with me and, hey, just go with this idea that, like, if this happened, you want to have some sense, like, well, what would the companies be worth? What would the government stake be worth? What would the stock that is trading, in the over-the-counter market, like, they didn't even allow it. The government just really essentially wanted people to forget that these things existed. So they wouldn't even let them trade on the New York Stock Exchange and NASDAQ. Anyway, so I want to just look at a bunch of sort of like boring, old, stodgy, banks and custodian companies. There's really genuinely no exact parallel for Fannie Mae and Freddie Mac. There's no one that has 65, 70% market share, tens of billions of dollars worth of revenue that's out there. So I looked at a company called State Street, Northern Trust, Bank of America, JP Morgan, and these are their price to sales. So generally speaking, so what, like 2 to 3 times sales, right? So let's just go with that. And if that 2 to 3 times sales, let's go value Fannie Mae and Freddie Mac using their sales numbers that I told you about. So I have to look at these numbers myself, right? So Fannie Mae, if we use 2 times sales as an indication, is worth about $63 billion. Yeah, 2 times sales, 31.5 billion. 3 times sales rockets up to $94.5 billion. Woo! Yeah, yeah, 94.5 billion, right? So I'll get to this line next. Freddie Mac with 22 billion in sales, 2 times sales, 44 billion, pretty straightforward. 3 times sales, 66 billion. But look at this, yeah? I mean, I think I should have it on the next slide, make it easier. Sometimes I just like, put all this information together. But essentially, if you look at the government stakes, Fannie Mae at 2 times sales, their stake in Fannie Mae is worth 50.4 billion at 3 times, 75.6 billion. Freddie Mac, 32.5, 35.2 billion, and then 52.8, for a total on the low side of 85.6, and on the high side 128.4 billion of theoretical value. Yeah, just theoretical value that the US government could generate by selling these stakes. And hey, within the context of $31.4 trillion, I get it. It's not a lot of money. But remember, you're scrounging around, and within the context of like, hey, you need $10 billion or $20 billion. If you look at what the US Treasury is currently doing to get through this period, because remember, we've hit the credit limit. It means that the US government cannot sell any additional bonds. They can refinance all bonds, but they either need more cash from someplace because, they got interest on the debt, which is going up. And then they've got all of the current obligations that they have. So they need money. And they need money. So we worked out what the government's upside is. What about for investors in these two little tiny stocks? What is the 20%? And remember, it's the government stake is a little bit under 80%, and the investor stake is a little bit over 20%. But I'm rounding because hey, I'm not a math genius. Yeah. Okay. Well, I could have done it precisely, but I think that would miss the point. We're just trying to get to general numbers here, which is that if the underlying scenario is correct, and I want you to focus on that idea first, which is that if the government decides that, hey, we've got these two stakes and we need the money, well, what might occur? I mean, it's a complete moonshot, idea, and many people will think of this as being crazy. And I want to warn people that, hey, there's no guarantee that this is going to occur, right? Simply no guarantee. These stocks have been in limbo, in purgatory for 14 years. Yeah. I mean, and so you're taking a chance of something very unusual, very, very unthought of, very contrarian. But hey, if it happened, woo, yeah, and I like to think in this way. I always like to think with big money. And sometimes it just happens in unsurprising ways. All right. Having said that, the 20% trading in the market, Fannie Mae at 2 times sales, that stub, if you will, would be worth about 12.6 billion. At 3 times sales, 18.9 billion. Freddie Mac, the stub at 2 times sales, 8.8 billion. At 3 times sales, 13.2 billion. And these companies are not currently, their market capitalizations are nowhere near that. I mean, they are tiny, tiny, tiny. They're like in the, yeah, I mean, I have this number here. I don't have to guess. Like, what are you doing? Come on. I just want to say it takes a long time. I literally sit there on my kitchen counter making these notes. I know it's super low tech, but this has become my signature, writing these tiny little notes, doing my show and tell. And hey, other channels got all this kind of fancy stuff. This is what we got. And I hope you like it because it's You're not coming here for fancy graphics. You're not coming here for any of that. You're coming here for a point of view about the world, a way of looking at investing, and that's really what I have to offer. And of course, every once in a while, some awesome, incredible, phenomenal, absolutely banger t-shirts. Yeah. All right, let's get to the point here. All right. So theoretical. I just want to I want to get a red marker and say theoretical upside for Fannie Mae and Freddie Mac. It's kind of crazy, right? Fannie Mae under 2 times sales, 12.6 billion, current market capitalization, $573 million. So that would be a 2,000, almost 2,100% gain, and about a stock price that's a little bit under $11. At 3 times sales, 18.9 billion, and that would generate a nearly 3,200% return and a $16 stock price. If you think I'm completely dumb, completely stupid, and you want to 50% mark it off by 50%, you would get to $5 and $8. So that's what that line is. For Freddie Mac, it's coming up with much higher upsides, which makes me question my numbers, because these are very similar companies, and the fact that this is that much different tells me that probably my assumptions underlying these numbers are wrong. So don't take it literally. All right. Okay. So for Freddie Mac, it's saying at 2 times sales, 8.8 billion. And that represents nearly 2,700% or $14 stock price. And under 3 times sales, 13.2 billion, which is nearly 4,100% or $20 stock price. Yeah, I mean, I just want to say again, those numbers, especially for Freddie Mac, seem off. They should be closer. But remember, the point of this exercise is not precision. It's generally to point to a hyper contrarian point of view about these two stocks that have been given up for dead. I mean, there's this, group, people like me who, have been following this for a very long time. And I actually, have owned the various preferred stocks of Fannie Mae and Freddie Mac for a while. We have recommended both at ATG Digital Media, which if you want coverage of this on an ongoing basis, check into the link below and it will send you to our website where you can subscribe. It is sitting in our gold tier, and that's where these stocks are located. But the point of making this video is to point to a very contrarian, very controversial viewpoint, which is that the government may be forced to make asset sales to get through this period where we come to an agreement about whatever we're going to do for the debt ceiling. And it's got these very valuable stakes in Fannie Mae and Freddie Mac. And if it were to sell it, you would suddenly now see a price that reflected something near its actual business value, its operating value, its market value. And if that were the case, in my judgment, in my opinion, not investment advice, losses, gains on you if you choose to follow anything in this video, the upside is potentially huge, potentially huge. And hey, these stocks went down in a waterfall decline. Could it go up in a rocket surge? I don't know. Things happen all the time, right? I mean, you just don't know. So that's the video for today. If you like this kind of way of looking at the world, you like my t-shirts, I don't know, for anything at all, subscribe to the channel, give us a thumbs up. So link to my Substack below too, where we use this kind of thinking, looking at the world in this way for growth stocks, crypto, and the world in general. And I mentioned again, we have subscriptions where we make recommendations to our model portfolio that you can follow along at ATG Digital Media. And with that, I want to say bye. Thank you. Come back again next week. This is Paul saying bye.